everyone, welcome to my channel where I give bookkeeping and tax tips to entrepreneurs and small business owners. My name is Christian Brooks. I'm the owner of Brooks Bookkeeping and Accounting Services, a bookkeeping and tax firm that aims to empower and educate entrepreneurs and small business owners on their business finances and taxes. So today I have a video for you all on some tax credits and deductions that I don't see a lot of people taking advantage of, but you all might qualify for. So without further ado, let's get into the video. Okay, so the first deduction that I'm going to talk about is the sales tax deduction. A lot of people don't realize that you can write off the sales tax that you've paid throughout the year. So you can either write off your state taxes or your sales taxes, whichever one is higher. You can't do both though. So if you have made a big purchase throughout the year, let's say you bought a car, you bought a house, keep track of the amount of sales tax that you've paid, because you can write off the sales tax on your taxes. Or if you're someone who just makes a lot of transactions, you spend a lot of money throughout the year on different things, track the amount of sales tax that you're paying for your groceries, if you're buying clothes, whatever you're paying for. Keep track of your sales tax because you may be able to write that off on your tax return. There are some apps out there that help you track your sales tax. All you have to do is link your bank account and your credit cards to those apps, and they'll track your sales tax for you. So if this is something that might be helpful for you, you might want to look into some of those apps to see if that can help you out with some tax savings on your tax return. Okay, number 2. So you can write off your tax preparation fees. So this only applies to businesses though. If you file your taxes on Schedule C, if you are a business filer, if you have rental properties, you file on a Schedule E, then this mainly applies to you. You can write off the amount that you are paying for your tax preparation fees because it is considered a ordinary and necessary business expense. Unfortunately, if you do not have a business or you don't have a rental property, any of those things, you are not able to write off your tax preparation fees anymore. With the Tax Cuts and Jobs Act, they did away with that. Sorry about that. However, if you are a business owner, if you file on a Schedule C, or if you have rental properties, Schedule E filers, you can write off your tax preparation fees. Okay, next up is mortgage interest. Okay, so I know a lot of folks know that you can write off your mortgage interest. However, there are some states that offer what's called the mortgage interest credit certificate. So with the mortgage interest credit certificate, you can actually take a tax credit for the amount of money that you've paid for your mortgage interest. And this is extremely helpful because tax credits and tax deductions are different. Tax credits will decrease your tax liability, whereas tax deductions will decrease your taxable income. So with the mortgage interest credit certificate, you'll get a credit of 20% of the amount of mortgage interest that you paid up to $2,000. And then the rest of the money, you can write that off. So for example, if you paid, let's say you paid $10,000 in mortgage interest, 20% of that, up to $2,000, you can take that as a tax credit against your tax liability, and the remaining $8,000, you can take that as an itemized deduction. But the thing with the mortgage interest credit certificate is that you have to apply for it when you buy your home. So when you purchase your home, you will tell your loan officer that you are interested in the mortgage interest credit certificate, and they would have to get all of the paperwork rolling on that. So unfortunately, if you are already a homeowner and you don't have the mortgage interest credit certificate, then you're not able to get it. This is something that you have to sign up for when you are purchasing your home. That's number 1. But number 2, the mortgage interest credit certificate is specific to different states. So though it is a credit for your federal tax return, different states have different qualifications to be able to meet in order to get the mortgage interest credit certificate. And then there are some states who don't have the mortgage interest credit certificate anymore. So if you are in the process of buying a home, look into the mortgage interest credit certificate. If you are thinking about buying a home in upcoming years, then look into the mortgage interest credit certificate. It is extremely helpful, and you get kind of like a 2-for-1. You get a tax credit and a tax deduction for the money that you paid on your mortgage interest. Okay, so lastly, the last thing I'm going to talk about are state tax credits. So there are states out here that are giving you a lot of money. People focus on federal a lot, I guess, because, you hear the IRS and ooh. However, you have states that are giving a lot of tax credits that you might qualify for. There are states that give money for property taxes. There are states that give money for buying an electric vehicle. Look into the credits that your state offers, because you might have a refund from the state that's going to be higher than your refund from your federal tax return. So do some research and look into some state tax credits that you might qualify for, as well as talk to your tax professional and ask them about some state credits that you might qualify for. I hope you enjoyed this video. If you have any questions or you're looking for a tax preparer, feel free to contact me. My information is in the description box below. Don't forget to like, comment, subscribe, and share this video with someone. Alrighty, see you next time.